You think the worst part is the $130,000 bill. It isn't. The initial shock of pulling that envelope from your mailbox, staring at the incomprehensible mathematics of a federal tax assessment, is merely the psychological beginning of your nightmare. The true horror, the absolute paralyzing reality of this specific financial mechanism is what happens when you finally realize that you cannot simply write a check to make the federal government go away. Bill paid or fighting it. Comment. Pay or fight down below right now, because your immediate reaction to that piece of paper will absolutely determine whether you survive this institutional sweep or whether you lose your entire generational wealth. In our previous investigation, we meticulously deconstructed the brutal architecture of the self-supply harmonized sales tax reassessment. We walked you through the exact legal mechanism where tearing your own property down to the wooden studs to build a multi-generational home legally transformed you, an ordinary citizen, into a commercial builder in the eyes of the federal tax algorithm. We showed you exactly how the simple act of moving your furniture back into your own newly renovated house triggered a deemed disposition, forcing you to mathematically sell your own home to yourself at the absolute peak of its newly inflated fair market value, generating a catastrophic six-figure tax bill. But receiving that official notice of assessment was just phase 1 of the government's protocol. Today, we are crossing the threshold into phase 2. We are entering the dark, uncompromising, and highly automated world of federal collections, and we are going to expose exactly how the system is engineered to suffocate you. We must completely shatter the comfortable illusion you currently hold regarding financial debt in this country. You are accustomed to dealing with standard corporate creditors, and you incorrectly assume the federal government operates under the same democratic restrictions. If you default on an unsecured credit card, or if you fall deeply behind on a private vehicle loan, you are dealing with commercial institutions that must ultimately navigate the provincial court system to force your compliance. They must file civil lawsuits. They must hire external collection agencies to harass you over the telephone. And they must petition a superior court judge to legally compel you to surrender your assets. The Canada Revenue Agency absolutely does not operate within that slow, balanced, and democratic judicial framework. They possess unilateral, extraordinary collection powers granted directly by the complex wording of the Excise Tax Act and the Income Tax Act. They are not a standard commercial creditor. They are the undisputed apex predator of the Canadian financial ecosystem. When you fail to immediately remit the $130,000 demanded by your self-supply reassessment, they do not need to take you to a provincial court. They absolutely do not need to ask a judge for permission to destroy your economic mobility. Under certain conditions, once the strict statutory payment timelines officially expire, the Federal Tax Authority can immediately execute 3 distinct terrifying levels of financial paralysis against you. First, they may issue immediate third-party garnishments. This means they can legally force your employer to intercept your wages, or they can legally force your commercial clients to redirect your business receivables directly to the federal treasury before that capital ever touches your personal checking account. Second, in extreme cases of documented gross negligence or deliberate coordinated tax evasion, they have the absolute statutory authority to facilitate the physical seizure and auctioning of your personal assets, including your vehicles and your investment portfolios. But it is the third mechanism that is the most utilized, the most silent, and by far the most structurally devastating to the middle-class homeowner. They can, and they frequently do, place a super priority federal tax lien directly on the legal title of your primary residence. This is the specific institutional mechanism we identify as the CRA Lien Trap, and it is meticulously designed to completely eliminate your financial leverage. You must deeply understand the physical and legal reality of a property lien. It is not a visible iron padlock on your front door, but it is an absolute, unbreakable digital chain wrapped permanently around your provincial land deed. When the federal tax authority registers a $130,000 encumbrance against your home, they effectively freeze your entire economic existence in place. Now, if you panic and attempt to sell the property on the open market to escape the crushing anxiety of the debt, the real estate transaction simply cannot legally close until the federal government is paid in full directly from the proceeds of the sale, taking absolute priority over almost everyone else in the capital stack. But more insidiously, the federal tax lien completely destroys your ability to access the equity you just spent years building. Imagine you receive the massive reassessment. You realize you actually owe the government the money, and you make the logical decision to visit your primary commercial bank. You intend to pull equity out of your newly renovated, highly valuable home to pay off the tax bill and amortize the pain over 20 years. You sit down with the mortgage specialist. And they run your application through the automated underwriting software. The banking algorithm pulls your provincial property title, instantly detects the active federal tax line, and immediately generates a hard, undeniable rejection. No Tier 1 lending institution in this country will ever register a new mortgage or approve a home equity line of credit behind a Canada Revenue Agency encumbrance. The bank views a federal tax lien as a catastrophic Tier 1 threat to their collateral because they know that in any forced liquidation scenario, the Crown always gets paid before the bank. You are permanently, unequivocally locked out of the conventional credit market. This is exactly why ordinary, hardworking, compliant people are being entirely financially eradicated by this specific trap. Consider the absolute reality of a homeowner we will call Sandra. Sandra worked for 30 years in a standard corporate job. She purchased a modest, aging bungalow in a suburban neighborhood. Recognizing that the housing market was mathematically detaching from reality, she decided to secure her family's future by executing a massive, comprehensive, substantial renovation on her property. She poured every single dollar of her liquid savings. She maxed out her unsecured lines of credit, and she utilized every ounce of her available liquid equity directly into the framing, the specialized plumbing, the electrical wiring, and the modern finishing of her new home. Upon completion, she is entirely cash poor. She is completely illiquid, but she is sitting inside a beautiful property that an appraiser would now value at over $2 million. When the automated algorithms at the Federal Tax Authority scrape the municipal permit databases, flag her massive renovation, and generate the self-supply reassessment demanding $130,000, Sandra experiences a total psychological collapse. She has absolutely zero cash in her checking account to pay the demand. Because she has no liquid cash, she misses the statutory payment deadline, and the federal government automatically registers the priority tax lien against her $2 million property. Because the federal lien is now permanently registered on her title, her commercial bank absolutely refuses to grant her a mortgage to access her massive equity. She is entirely trapped in a perfect, inescapable, mathematically engineered paradox of illiquidity. She is slowly being suffocated and bankrupted by a massive, valuable asset that she technically owns on paper, but can no longer financially control or leverage. The government has essentially weaponized her own sweat equity against her. Stay with me right now. Do not click away from this investigation, because this is the exact moment where the institutional system uses your own fundamental instinct for justice against you. This is exactly how the punitive interest keeps compounding, growing silently in the background like a financial cancer, even while you believe you are actively, aggressively appealing the government's decision. When you receive a tax assessment that you know in your heart is fundamentally unfair, legally incorrect, or based on a flawed theoretical appraisal of your home, your immediate, but logical response is to fight back against the machine. You hire an accountant, you gather your paperwork, and you formally file a notice of objection with the Federal Appeals Division of the Canada Revenue Agency. You drop that envelope into the mail and you breathe a massive, profound sigh of relief. You assume that because the matter is officially under formal legal dispute, the entire collection process is completely, unconditionally paused. You believe that the financial bleeding has been halted while the rational bureaucrats review your specific file. This is the objection trap, and it is a devastating, highly engineered psychological illusion designed to lull you into a false sense of security. While filing a formal notice of objection may, under specific administrative guidelines and internal policies, temporarily pause certain aggressive physical collection actions for standard personal income tax disputes. The legislative rules governing the Harmonized Sales Tax and the Excise Tax Act are often significantly more aggressive, complex, and unyielding. But even if the physical collection calls stop and the immediate threat of asset seizure is temporarily placed on hold, the brutal mathematics of your destruction absolutely never stop. The Canada Revenue Agency continues to aggressively charge compounding daily interest on the entire outstanding principal balance for the entire agonizing duration of the formal dispute. You must understand the terrifying reality of the federal appeals timeline. The Internal Appeals Division of the Tax Authority is completely, structurally overwhelmed by the sheer volume of reassessments currently being generated by the automated algorithms. When you file your formal objection, your physical file is placed into a massive bureaucratic holding pattern. It may sit on a desk in a federal processing center for 12, 18, or even 24 solid months before a human appeals officer ever officially opens the folder to begin investigating your case. During those 2 years of absolute bureaucratic silence, you are accumulating massive amounts of non-deductible interest at highly punitive, legally mandated federal rates. If you ultimately lose the appeal, which happens in a staggering, terrifying number of cases where homeowners attempt to represent themselves against specialized federal tax litigators, you do not simply owe the original $130,000. You now owe the massive original principal plus 2 solid years of aggressively compounded daily interest, transforming what was already a massive debt into an absolute insurmountable financial mountain. The delay tactics inherent in the bureaucratic system actively work to mathematically destroy your ability to ever recover. If you have recently received a Canada Revenue Agency letter regarding your home construction, a renovation, or a harmonized sales tax audit, stop what you are doing and comment ME plus your province down below right now. We need to see the exact geographical locations where these automated algorithmic sweeps are currently concentrated. You are currently standing inside a burning financial structure, but the exits are not completely sealed if you act with absolute surgical and immediate precision. If you are currently operating within the 4-year statutory assessment window, or if you have just recently sold a substantially renovated property and are waiting for the inevitable audit letter to arrive, you must immediately execute 5 critical, absolutely non-negotiable steps to insulate yourself from the crushing reality of the lien trap. Step number 1, you must aggressively gather, organize, and digitally preserve every single piece of documentary evidence before the institutional memory fades and the contractors disappear. You must forensically reconstruct the timeline of your own life. You need to pull the original multiple listing service photographs and appraisal reports from the exact moment you purchased the dilapidated property, proving its original condition. You need the structural engineering reports, the original municipal building permits, and the final occupancy certificates. You must compile every single contractor invoice, material receipt, and bank statement proving exactly where the capital originated and exactly how it was deployed. The federal auditor who eventually opens your file will demand absolute, ironclad documentary proof. Your passionate verbal explanations regarding your intentions are entirely worthless in a federal tax dispute. If it is not heavily documented, it simply did not happen in the eyes of the algorithm. Step number 2, you must sit down right now and write a comprehensive and legally coherent and entirely chronological timeline of your entire renovation project. The legal definition of a commercial builder under the highly complex wording of the Excise Tax Act hinges almost entirely on your documented primary intention at the exact moment the construction began. Did you intend to flip the property for a profit, or did you legitimately intend to live in it as your primary residence? You must document exactly when the demolition started, exactly when the drywall was finished, exactly when you physically moved your belongings into the property, and exactly what your primary intention was at every single stage of the build. The Canada Revenue Agency auditors are highly trained forensic investigators. They will actively look for any contradiction in your story. They will subpoena your text messages, bounce your emails to real estate agents asking for theoretical market valuations, and your social media posts to prove that you intended to sell the property all along. A timeline full of inconsistencies will be used to instantly validate the massive assessment and destroy your appeal. Step number 3. You must mathematically calculate your absolute worst case scenario. Do not operate your life on blind hope or the assumption that the government will simply overlook your specific municipal permit. You must sit down with a calculator and determine the exact potential assessment you are facing. You must research the current fair market value of your home upon completion of the renovation. Apply the precise harmonized sales tax rate for your province, and then calculate the potential compounding interest from the date of occupancy. You need to know the exact terrifying size of the financial explosive that is currently sitting silently under your newly installed hardwood floorboards. Only by understanding the absolute maximum mathematical risk can you properly structure your defensive strategy. Step number 4. You must completely bypass your standard, friendly neighborhood accountant and immediately consult with a highly specialized tax attorney or a chartered professional accountant who focuses almost exclusively on goods and services tax, harmonized sales tax, and complex real estate transactions. A generalist accountant who primarily handles standard corporate payroll, annual T4 slips, and basic dividend declarations will absolutely not understand the dark, intricate, and highly punitive nuances of Section 191 of the Excise Tax Act. They will not understand the jurisprudence surrounding the substantial renovation threshold, and their generic, outdated advice will walk you directly into the objection trap. You are facing a specialized federal execution, and you require specialized, aggressive legal armor to survive it. Step number 5. You must absolutely, unconditionally avoid the desperate temptation of utilizing private, high-interest shadow lending if your property title is still currently clear, but you are panicking about a potential incoming tax bill. When homeowners realize the magnitude of the self-supply rules, they often panic. They realize they cannot get a conventional bank loan because their income does not support the newly inflated mortgage mathematics, so they turn to the secondary, unregulated lending market. Taking out a massive secondary mortgage from a private shadow lender at 12, 15, or even 18% interest simply to stockpile cash to pay a theoretical tax bill will destroy your monthly household cash flow significantly faster than the federal government ever could. You are essentially replacing a potential future debt with an immediate, mathematically crushing financial obligation that guarantees your bankruptcy. You must preserve your financial leverage, maintain your monthly liquidity, and execute a deliberate, highly calculated, and legally sound defense strategy. The federal algorithms are actively, continuously sweeping the municipal permit databases across every major city in this country. They are systematically hunting for the substantial renovations. They are calculating the theoretical newly inflated property values, and they are automatically preparing the devastating assessments. The lien trap is waiting silently in the dark for those who fail to recognize the magnitude of the threat. But the mechanics of the harmonized sales tax contain even deeper, exponentially more complex layers of institutional wealth extraction. In our next comprehensive investigation, we are going to explore two completely different, equally terrifying avenues of this ongoing housing crisis. We will either completely deconstruct the highly specific owner built housing rebate, exposing the rigid, unforgiving statutory deadlines and the exact, highly bureaucratic checklist you must perfectly follow to recover your trapped capital from the government, or we will investigate the terrifying, hidden reality of the basement suite double assessment, where adding a simple single rental unit to help pay your mortgage triggers a catastrophic, multi-layered tax event that can instantly vaporize your equity. The choice of what we expose next is entirely yours. Next, rebate or basement comment. Rebate or basement down below right now so we know exactly which trap is threatening your specific neighborhood. Stay highly vigilant, stay completely informed, and protect your remaining family equity from the silent, algorithmic execution of the federal tax lien.